Hello and welcome to Session 3 of the Basic Tax course. We're going to begin Session 3 with a review of the Session 1 quiz answer key. Right here I've got the quiz, and over here I have the answer key. And I'm going to begin today by giving you the first password of the day as well. The first password of the day is Starship. S-T-A-R-S-H-I-P. That is the password that will allow you to unlock the quiz answer key. Now, I do want to warn you that I will not, as a habit, be giving you the password to unlock the quiz answer key at the beginning of every session. The methodology or the mind behind that is that we do want students watching the lecture videos and not just jumping to points, grabbing passwords, and leaving. So you should not be looking for any predictable pattern under which I will deliver passwords during any particular session. But today, from the start, I will give you the password for the Session 1 quiz, and if you would like to, at this point, go open it, you can, but I will be referring to it on the screen right here as I go. Also today, I am going to take the time to go through every single quiz question, but after today, I will only review those questions that I feel are the most difficult or that were the trickiest or the most missed. And after today's class, when you want to review a quiz in more detail, you'll just need to read it on your own, along with the corresponding answer key. And then if, of course, you still have a question after reviewing the quiz answer key for today's class or any class, that is the purpose of the Q&A forum. But just as a reminder, before you post a question in the Q&A forum, please do read the answer key. Please do read the references that the answer key points out, for example, a page in Pub 17. And if after thoroughly researching those aspects that have already been provided to you in the course material, you still need to answer or have a question answered, by all means go to the Q&A forum and post the question. Please reference the test that you have a question about, the question number of the test, and specifically what it is that's confusing you, and then we'll be more than happy to post an answer. Alrighty then, question number 1. John, age 50, is single and a citizen of the United States and living in Canada. In which of the following circumstances must he file a return? I'm going to point out option number B. John is not required to file because he did not live in the U.S. That's a completely bogus statement, absolutely false. His filing requirement is not based on where he lives, but rather on his income and his age. And the fact that he is a U.S. citizen means he's going to pay or be required to file a return based on his worldwide income, no matter where he lives in the world. So the correct answer ultimately ends up being question D. And the reason for that is that his filing requirement is going to be based upon the adding two numbers together, the first one being his standard deduction, the second one being his personal exemption amount. And if we refer to Pub 17, I'm just going to pull that up real quick, Pub 17 being right here, and we look at the filing requirements in Pub 17, we see that a person who is under age 65 and single has a filing requirement of $93.50. That is the total of $5,700 plus $36.50. And we see that if his income is $93.50 or higher, he is required to file. A is $93.50. He's required to file with that much income. And if he has $200 more income, he's still required to file. So that is why D is the correct answer. Moving on to number 2. Jack, age 62, is married to Betty, age 61. Betty is legally blind. Jack and Betty are required to file a tax return in which of the following situations? And so we give a variety of different income amounts. Ultimately, we go over and look at their filing requirements. Now, even though Betty is blind and will ultimately be allowed to claim a higher standard deduction, that higher standard deduction does not affect her filing requirement, which is only based on her age and her filing status. So married filing a joint return, both spouses under age 65, the filing requirement is $18,700. And so let's look to see how much of these income lines is more than that or equal to that. And we can see that both A and B are equal to or greater than $18,700. So that means the correct answer is D, both A and B. Number 3, Sally is self-employed and did not receive a Form 1099 miscellaneous. Gross receipts for her business were $5,000 and net profit for her business was $350. Sally is required to file a tax return, true or false? Ultimately, the answer is false, although it would seem logically that she may not need to file, or pardon me, that she should be required to file. And the reason for that is that $5,000 of income is certainly more than what Table 3 or 1.3 points out in Pub 17. And if you go to Item 3 on Table 1.3 from Pub 17, it says you had net earnings from self-employment of at least $400. You are required to file. And if her income is only $350 net, then technically, according to Pub 17, she is not required to file. However, I can promise you that if she did receive a 1099 miscellaneous showing $5,000 of income, she would definitely get a letter from the IRS telling her she needs to file. Okay, number 3, Jenny is a dependent of her parents, and she worked part-time over summer vacation and earned $4,500. She also has investment income of $600. She is required to file a return, true or false? Well, the answer is true, and let's go up a page in Pub 17 and look at the filing requirements for dependents on Table 1.2. The filing requirements for dependents say, do you have income of at least $950? The answer is yes, she has income of more than $950. Does she have earned income that was more than $5,700? Well, no, she doesn't. Her earned income is only $4,500. So then we move to the final bullet here that says your gross income was more than the larger of $950. Yes, it is. Or your earned income up to $5,400 plus $300. Well, her earned income is $4,500, but we're going to add $300, and if we do that, her total income is more than her earned income of $4,500 plus $300, which is why she is required to file a return. So going back to the answer key, we'll see here that number 4 is true. Yes, she is required to file a return. Moving on to the next couple of questions on the first page of the quiz. Question number 5. Interest and dividend income can be reported on Form 1040-EZ. Is that a true statement or a false statement? Well, that is a false statement. Dividend income cannot be reported on 1040-EZ. Interest can. Dividend income must be reported on 1040-A or 1040 long form. Number 6, you can use Form 1040 to report which of the following sources of income. And we go just think mentally in our head, what can we report on 1040-A? The answer is yes, interest and dividends, no to capital gains, yes to unemployment, yes to pension. And you would never get a question like this on a federal or state exam. This is just an April question. I really want to kind of pinpoint what you can and cannot do. And so the correct answer for this question is actually E. But most multiple choice exams would never give you more than 4 choices. April likes to make her tests harder. Question number 7. Jessica had a balance due on her federal tax return of $500, and she cannot afford to pay her balance due. Jessica decides to file an extension so that she can save money to pay her balance due by October 15. Which of the following statements is true? Jessica can mail her return and her balance due on or before October 15th without being charged interest or late penalty. A dream come true, but no, that's false. B, Jessica will be assessed interest against her balance due beginning on April 15th. That is true. She filed an extension, but it is not an extension of time to pay. It is only an extension of time to file, and beginning on the date that she does not file, interest begins to accrue. And then number C, she is filing an extension, so she won't be filed any interest or penalties at all. That's simply a false statement. Number 8, Sam is a U.S. citizen serving in the Army. He was stationed in Guam on April 15. Sam's income was $9,000. Which of the following statements is true? Ultimately, we give you 3 bogus statements followed by a statement that is true. Sam has until June 15th to file his U.S. tax return, but he will be assessed interest on any balance due beginning on April 15th. So let's just see what the answer key has to say about that. The answer key says to refer to IRS publication page 10 for individuals outside of the United States. And so we'll just flip down until we get to individuals outside of the United States on what is essentially page 10 of this publication. And here we have. So individuals serving outside of the United States or individuals living outside of the United States right here. You are allowed an automatic 2-month extension until April 15, 2011 if you use the calendar year to file your 2010 return and to pay any federal income tax due if you are a U.S. citizen or resident and on the due date of the return you are living outside of the United States and Puerto Rico and your main place of business or post of duty is outside of the United States or Puerto Rico. However, if you pay the tax due after the regular due date, generally April 15, interest will be charged from that date until the date the tax is paid. So that is why question number 8, the answer is D. Moving on, number 9. Bob, age 28, is a resident of the United States. Bob's wife, age 25, and children, age 3 and 4, are residents of Canada. Bob's wife does not have any income of her own, and Bob sends money to Canada to support his wife and children. Bob will file a joint return with his wife. What is the minimum income level at which he must file? We give you 4 options, but ultimately the first option, A, is the correct option. So let's just flash back to the filing requirements on Table 1.1 of Pub 17. And here you'll see that if you are married and you file jointly, the filing requirement is showing $18,700 in the table. However, if you scroll down the page just ever so slightly to right here, and I'm kind of wobbling around, let me get this draw on to lock it. If we go down the table, and I'm just going to highlight the caption that I'm interested in, it's right here. It says, if you did not live with your spouse at the end of 2010 or on the date that your spouse died and your gross income was at least $36.50, you must file a return regardless of your age. So even though he's filing a joint return with his spouse, and he will ultimately be allowed a number of deductions, including a standard deduction at times 4 exemptions, as well as 4 exemptions rather, he's not going to have to pay income tax until his income is far in excess of $36.50. But the IRS table is telling you that the filing requirement comes at only $3,650 of income. Moving down, question numbers 10 and 11. In which of the following situations should you file a return even if you are not required to file? You had income tax withheld from your pay? Absolutely. You qualify for the Earned Income Credit? You bet. And you qualify for the Additional Child Tax Credit? That one definitely too. So of course 10 has to have been one of the easiest questions we gave you today. And the correct answer is D, all of the above. Number 11, a dependent that had no earned income and received investment income of $850 during the year is required to file a return. The answer to that is false, and it's not hard to see why. We simply go to the filing requirements for dependents, get back to this particular table right here, and it says your unearned income was more than $950. Well, the unearned income was not more than $950, it was less than $950. So false, not required to file. Number 12, a child under age 19 who qualifies as a dependent of his parents receives $1,800 of interest income during the year. Since this is his only income, the child will not be required to file a tax return. Well, that's false for the same reasons we go here. That child is going to be allowed a standard deduction of $950 only. His income is more than that, so obviously he is required to file. Number 13, for tax purposes, an individual is considered to be 65 on the day preceding his 65th birthday. That answer is true. And just in the answer key here, we tell you to reference Pub 17, page 5. Look at the topic called age, and it will tell you that. Number 14, a married filing separate taxpayer who earned $3,650 is required to file a tax return. That is a true statement. Again, looking at Table 1.1 and the asterisk points underneath it. Number 15, a taxpayer may file a refund claim up to 3 years after the return was filed or 2 years from the date the tax or a portion of it was paid. The answer to that is false, and this is one of the more confusing questions for our students. We get lots of complaints about this every year, so we've gone out of our way to make the answer key really detailed, and I'm going to refer to the answer key as I read the information that we're giving you on this particular problem. Zoom in a little bit so it's easier for you to follow along. The correct answer to 15 is false, and let's see why. You would refer to publication 17, page 17, time for filing a claim for refund and limit on the amount of refund. A claim for refund must be made within 3 years of the due date of the return. That's very different wording than 3 years after the return was filed. Okay? Next, a claim for refund must be, a claim for refund must be made within 3 years from the due date of the return, including extensions, except for tax paid by the taxpayer within 3 years of filing, or within 2 years after the date the tax was paid, whichever is later. So this problem confuses many students because it sounds correct where it is just partially correct. A taxpayer may file a claim for a refund on a return within 3 years of the due date of the return, including extensions. But outside of this rule, another rule states that a taxpayer can claim a refund for taxes paid within 3 years of the filing of the return or 2 years from the date that the tax was paid. So the difference is illustrated in this example which follows. Sally files a late 2004 return in 2007 and pays $500 of balance due with her return. Then 3 years later, or less than 3 years later, she amends her return to claim a refund of $3,500. Here's what's going to happen. The IRS will issue her a refund of $500 and not $3,500. She is entitled to the $500 because she is filing a refund claim within 3 years of the original filing of her 2004 return and the date that she paid $500 of tax. But she's not entitled to the other $300 or $3,000 of refund because her refund claim was made more than 3 years after the due date of the return, including extensions. All right, number 16. Number 16, you may round off cents to the nearest whole dollar when filling out your tax return. Which way is the correct way to round off? Ultimately, the correct answer is number B. You may drop amounts of 49 cents or less to the nearest whole dollar, and anything that is 50 cents or up goes up to the next whole dollar. The IRS doesn't want you entering cents on the tax return, and most computer software will not allow you to enter cents. And if you do enter cents, the software will round it for you. Which is why actually in our LMS, when we ask you to enter answers, we're going to be asking you to always round up or down to the nearest whole dollar, and you're going to have to use these rounding rules to do that correctly. So if you round up where you should have round down, the LMS will tell you you got the answer wrong even though you're within $1. So it is important to pay attention to those rounding rules when you're entering answers into our LMS for any of the tests that you take. Number 17, you should save your tax records for at least how long? Well, April says forever, but the IRS Publication 17 says 3 years. And you could refer to page 16 on how long to keep your records in Pub 17. Number 18, the deadline for filing your tax return and paying any tax you owe is extended automatically if you serve in a combat zone. That is absolutely true. And you would refer to Pub 17, page 10, individuals serving in a combat zone for more information. Number 19, you can wait until January to cash your check that you receive in December in order to defer taxes until the next year. That is false. You are required to report income that you receive in the calendar year or that you constructively receive and have access to in the calendar year. So if you elect not to deposit a check just to make the claim that you didn't have access to it, that would actually be a lie. So that is why 19 is false. Number 20, Mrs. Smith is age 65 and blind. Her husband, Mr. Smith, is age 64. The Smiths will file a joint return. What is their federal standard deduction? So the federal standard deduction is $13,600, and how do we get that? Well, $5,700 times 2 plus Mrs. Smith gets, Mr. Smith is 65 and he's blind, so he's going to get an additional $1,100 twice. So $5,700 times 2 plus $1,100 times 2 is going to give us $13,600 as a standard deduction for the Smiths. Jonathan is single. Number 21, his parents will claim an exemption for him on their 2010 tax return. He has interest income of $690 and wages of $250. He has no itemized deductions. What is his standard deduction? So even if you take $690 and add $250, you're only at $940. But the minimum standard deduction for a dependent in Pub 17, according to the table 1.3, is $950, and that's what he's going to go with. Certainly do not take the $250 of earned income and add $300. He's allowed more than that. Betty, number 22, is a 23-year-old full-time student and is claimed on her parents' 2010 tax return. Betty is married and files a separate return. Her husband does not itemize deductions on his separate return. She has $1,500 of interest income and wages of $2,000. What is her standard deduction? So we're dealing with a dependent here. But she is, let's read the instructions here. 23, claimed on her parents' return, files separately, what is her standard deduction? Her standard deduction is going to be her earned income of $2,000 plus $300. And when we do that, we get $2,300 is her standard deduction. Number 25. If you are paid to prepare a federal tax return for an individual, you must have a PTIN from the IRS to put on the return. That is law now. Prior to 2011, it was not law, but if you are preparing a 2010 tax return, you would have done so in 2011 or later tax season. So it is now law, and anyone preparing a 2010 tax return would be expected to put PTIN on the return and is in violation of PTIN registration rules for failure to put a PTIN on the return. And finally, number 26, if you do not file your federal return by the due date, including extensions, the penalty is all of the above. And let's look at the rules here. Usually not more than 25% of the tax not paid by the due date. Usually it's 5% a month or part of a month up to 5 months. So 5 times 5 is 25%. And the penalty is higher if the return is more than 60 days late. So you basically get to a minimum number on the return if it is that late. And of course, you would refer to Pub 17, page 18 for more information on those penalties. Okay, so that's the conclusion of the review of the Session 1 quiz answer key. So if you did well on the quiz, great for you. If you had some problems or if you're struggling with some of the concepts on that quiz, then it would be worth it to you to go back and spend some time reviewing Session 1 before you move on to today's lecture with Session 3. Having said that, I'm going to close out of the Session 1 quiz and quiz answer key, and I am going to open up now the homework assignment for Session 2. So of course the Session 2 homework assignment was shown in the student manual at the very end of the manual. I'll just go to about page 29. And there were 2 homework assignments B and A. So let's start with homework assignment A. And I am also going to open up the homework assignment answer key. And let me just grab that. So here is the homework assignment answer key. And I will give you a second password of the day. This password will allow you to unlock the homework answer key for Session 2. And that password is Adelaide, A-D-E-L-A-I-D-E. Adelaide is a city in Australia and one of the larger cities in that country. So A-D-E-L-A-I-D-E is the Session 2 homework answer key password. Let's now look to Session 2 manual and the problems contained in that manual. The instructions for the Session 2 homework assignment were to look at each of the filers described in the problems and identify all possible filing statuses available for that filer. And earlier in Session 2 for the classwork, we asked you to identify the best filing status and to use that to fill out the header of the return. But for homework, we're giving you a little bit more challenge. We're asking you to think of every possible filing status. So the correct answers, if you were hand filling out the answer key, would be single, represented by an S, married filing joint, represented by MFJ. Of course, if you're entering the answers in the LMS, we just offered those as multiple choice options. But for some taxpayers, only one filing status is available, and for others, there may be more than one filing status available. Enter all legally possible answers in your answer key. So if you enter only one answer when there are 2 answers, then you would only get 50% credit for that particular question. Test taxpayer lives at 1010 10th Avenue in Beaverton, Oregon. She's married to John. John moved out of the house in July. Test paid over half the cost of maintaining a home for her and her dependent. List all possible filing statuses that are available to her. Head of household is not one of the options because her spouse lived with her in the last 6 months of the year. So her choices are married filing separate or married filing joint. Those are her 2 choices. Number 2, Samantha Jones is married to Mark Jones, and they reside in Happy Court in San Francisco. Samantha wants to file single because they were married in September and spent most of the year as single. Well, what they've spent for most of the year is irrelevant. What we look to is what was their marital status on the last day of the year, and the marital status on the last day of the year was married. So she's left with 2 possibilities, married filing joint with Mark or married filing separate. Zetta Smith divorced her husband in December. Zetta's 30-year-old single daughter, Beth, lived in Zetta's home all year. Beth didn't work much last year and earned only $2,500. Therefore, Beth is a qualifying relative, and Zetta can claim her as a dependent. Zetta paid more than half the cost of keeping up her home. List all possible filing statuses allowable for Zetta. Well, she's got 2 possible filing status choices. One is head of household, and the other is single. And since she has a qualifying person for head of household will be the better choice. But ultimately, she does have those 2 possibilities available to her. Number 4, Zetta Smith's situation is the same as in problem 3, except that her daughter Beth worked all year and does not qualify as a qualifying relative. What are the possible choices available? Well, single is what's available. In order to be head of household, you have to have a qualifying relative. And under situation number 4, Zetta will not have a qualifying relative because her child, Beth, will have failed the gross income test under the test for qualifying relative. Number 5, Jack Sunder lives on Rainy Day Lane in New York. His wife, Martha, died last year, 2009. And Jack's stepson, Johnny Lane, lived with Jack all year. Jack paid more than half the cost of keeping up his home. List all possible filing status choices available for Jack. Well, Jack's wife died in one of the 2 preceding years, and he does have a dependent child for whom he paid more than half the cost of keeping up a home. Also, the child lived with him all year. So ultimately, he could qualify as a qualifying widower with the dependent child, but he could also qualify for single or head of household. And of course, qualifying widow with dependent child is going to give him the best tax advantage. 6, Zane Gray is single and paid over half the cost of keeping up at home in Houston, Texas for himself and his son Joshua, age 5. Zane's ex-wife Laura claims Joshua as a dependent. List all possible filing statuses available for Zane. Well, clearly the best filing status option is head of household. So long as Zane is single and paid over half the cost of keeping up a home for his unmarried son, he can be head of household even though he cannot claim a dependency exemption for his son, so long as he would have qualified to claim the dependency exemption if the divorce or separation decree had not given it away. But of course, he could choose to file single, though why would he? Single is the other option available. 7, Sally Summers is married to John Summers. Sally lived with John all year in Aloha, Oregon, but doesn't want to file a joint return. Sally earned most of the household income and considers herself to be the head of household. She wants to file as head of household and claim her 2 children as dependents. List all possible filing statuses for Sally. Well, Sally's personal wishes in this regard are really not relevant. The fact that she thinks of herself as a head of household does not make her head of household. She has to independently meet all of those tests, and she fails them. So she does not meet the test to be head of household. Therefore, that is not a filing status choice available to her. She must file married filing joint or married filing separate. Those are the 2 choices available. And of course, between those 2 choices, joint will be most likely the better choice. Number 8, Sam Sanderson is married to Jill Smith and lives at 333 Northeast 33rd Avenue in Memphis, Tennessee. Jill has been in a nursing home all year because she is ill, and their son John, age 16, has been at a home all year. List all possible filing statuses available for Sam. So referring to the answer key, Sam can file married filing joint or married filing separate. Even though his wife was not living with him at any time during the year, her stay at a nursing home is considered to be temporary. A temporary absence from home is considered to be time spent at home, and Sam will therefore probably be better off filing jointly. Head of household is not a choice available to him. Number 9, Sandy Peters is single and lives at 1234 9th Avenue in San Francisco, and she pays more than half the cost of maintaining a separate household for her mother, Jean, who qualifies as Sandy's dependent. List all possible choices available for Sandy. Well, she's going to basically boil down to head of household or single. and clearly head of household will be the more advantageous filing status. Jackie Jones is married to John Jones. They live in Virginia Beach, Virginia. John, a Marine sergeant, left home in May and has been in a combat zone for the past 7 months. Jackie has a dependent child and worked part-time during the year. List all possible filing statuses available for Jackie. Well, although it might seem convenient to be able to claim that Jackie is head of household, her husband is away from home on a temporary basis. And if you look to the instructions in Pub 17, they tell you on page 20 what to do when you have a spouse in a combat zone. And they also, in Pub 17, provide additional information about temporary absences. So time spent in the military is a temporary absence, and time spent away from home for temporary purposes is considered to be time spent at home. So she will not be able to treat herself as if she did not live with her spouse in the last 6 months of the year. In fact, it is the opposite. But because the spouse is in a combat zone, it is also the case that she might be able to even sign the tax return for him in his absence. So she shouldn't be considering filing head of household because he's not around to sign the return. There's specific provisions that say she can sign for him. Number 11, Mike Mitchell maintains a small apartment for himself and his son George. George lived at home for Mike for 7 months last year. Mike lived apart from his spouse, Jane Mitchell, for the entire year. List all possible filing statuses available or allowable for Mike. Well, Mike Mitchell boils down to married filing separate or married filing joint if he and his wife can agree to file a joint return. If Mike is able to show that he can claim his son's dependency exemption, or would have been able to claim it except for the fact that he signed 8332 or a similar statement, he can choose to file as head of household. The reason for that is that his wife did not live with him for the last 7 months of the year. He maintained a home for his child, and he is the person who's allowed to claim the exemption for the child. Even if he signs that child over as an option, it would not take away from him that ability to file as head of household. So 3 choices available to Mike. He could file separately, he could file jointly with his spouse, or he could file as head of household. Number 12, Jane Mitchell is married to Mike Mitchell. Same situation up here. So Jane is the one married to Mike. And she kept up a home for herself all year. Her son George lived with her for 5 months. List all possible filing statuses allowable for Jane. Well, Jane is going to be allowed to file married filing separate or married filing joint. And if Mike does not want to file jointly with her, she's going to be left with separate while he goes for head of household. 13, Tiffany Smith was widowed in 2009. In 2010, her 19-year-old son left home to go to college. He is attending Oregon State University and has a part-time summer job. Jake comes home for summer and Christmas, and Tiffany keeps up her home all year. Assuming Jake does not provide more than half of his own support, what are the possible filing statuses that Tiffany can use? Well, Tiffany can use qualifying widow with dependent child. Even though Jake has spent only a few weeks at home during the year, his time away at school is considered to be a temporary absence, and therefore she is considered to be keeping up a home for him. She meets the test for qualifying widow. She could also file as single or head of household. So there are 3 possible choices for number 13. Number 14, assume the same facts as in question 13. What possible filing statuses can Jake use? Well, Jake is unmarried and his filing status would therefore be single. Number 15, Sally Hamper is not married. She keeps up a home for herself, and her boyfriend, who lived with her all year but did not work and was a full-time student. List all possible filing statuses available for Sally. Well, Sally is single. She will not qualify for head of household because the person that she's keeping up a house for is not related to her. And in order to be head of household, you have to keep up a house for a person who is related to you. Or in certain situations, you might have a qualifying foster child that was placed with you by an authorized agency. But she's not meeting those tests for sure with a boyfriend. Number 16, Laura Jones is 18 years old, and her 7-month-old daughter lived with her from the time she was born. Laura worked 5 months during the year. She did not pay more than half the cost of keeping up her home during the year. List all possible filing statuses allowable for Laura. Well, Laura is single. She doesn't have any other choices available to her. She's not eligible for head of household filing status. Whoever could possibly be eligible for that status is going to be the person who paid more than half the cost of keeping up a home, and that certainly wasn't Laura. All right, so that concludes homework assignment A. Let's move on to homework assignment B. Homework assignment B was challenging in some new ways. It was asking you to consider multiple factors for every single problem, not just filing status, but also moving on to the number of qualifying children, the number of qualifying relatives, and the number of dependents that are eligible for the child tax credit. So this is really kind of a brain teaser. We're asking you to think about multiple scenarios for every single problem, or multiple decisions that must be made with respect to every single problem. So let's begin with number 1. John and Martha, a married couple, paid over half the cost of supporting their daughter, Georgia, age 28, who was unemployed during 2010 and had no gross income. So let's look at what's going on here. John and Martha, a married couple. So they're paying over half the cost of supporting their daughter, Georgia, 28 and unemployed. Well, is Georgia going to be a qualifying child? The answer is no. She's too old. She's not disabled, so she's not going to meet an exception to the age test for qualifying child. So the most she can be is a qualifying relative. Does she meet the test for qualifying relative? Well, the answer is yes. If you were to go through all of the tests for qualifying relative, she would pass those. Is she eligible for the child tax credit? The answer is no. She's too old, plus she's not a qualifying child. Number 2, Jack and Jane are married. Their daughter Alice was born in December of 2010. Alice lived with her parents, who provided all of her support. So what is the filing status of the parents? Well, they're going to be filing joint. They will have one qualifying child, who is their daughter Alice, and Alice will qualify them for the child tax credit. Number 3, Stephen provides all of the support for his girlfriend Frances and her son Jake, age 8, who lived with him all year. He is single and he is not related to Frances or Jake. Well, this one's kind of a bummer, if you want to get right down to it. He seems to be doing all of the work and doing all of the support, but because he is not related to either his girlfriend or his girlfriend's child, he is not going to qualify for head of household. So both his girlfriend and his girlfriend's sons meet the test for qualifying relative in terms of having a dependent, but he did not keep up a home for a qualifying person who is related to him. So please refer to Table 2.1 on page 22 of Publication 17 and read the second item from the bottom in the middle column. He has 2 qualifying relatives, but none of them qualify him for head of household, so ultimately his filing status will be single. He will claim 2 dependency exemptions. He will claim no one for the child tax credit. Number 4, Terry, aged 40 and single, provided over half the cost of supporting his mother, Joan, aged 71, who lived with Terry the entire year. Joan received $7,200 in non-taxable Social Security and earned $1,895 of interest income on money she has in her savings account. So what is going to be the filing status of Terry? Does he have a qualifying relative? And does he qualify for the child tax credit? Well, ultimately, his filing status will be head of household because he does have a qualifying relative. His mother is related to him. He keeps up a house for her, and she is his dependent. Now, the fact that she has $7,200 of income should get your alarm bells going, but if the only source of income she has is Social Security and that Social Security is non-taxable, then it does not factor into the gross income test. So ultimately, she does not fail any of the tests necessary for being his qualifying relative, and she makes him head of household. Number 5, Sandy and her husband Kurt are sending their child, Jeff, age 23, to Portland State University. Jeff was a full-time student for 6 months. He earned $5,500 working at the local gas station. Sandy and Kurt provided over half of his support for the year. So what is going to be their filing status? Well, married filing joint is going to probably be the most advantageous, but they could file separately. The child is a full-time student, but he is under the age of 24, so that makes him a qualifying child. The fact that he earns $5,500 is not relevant because they're providing more than half the cost of his support, and therefore he will be their qualifying child. But he is too old to be eligible for the child tax credit. Number 6, Stacy and Herbert are a married couple who provided all of the support for their daughter, Susan, age 19, who lived with them all year and was not a student. Well, since she is not under age 19, she cannot be a qualifying child unless she is a student, and she's not. So she fails the qualifying child test, and we're going to move over to the qualifying relative test. Underneath the qualifying relative test, her income must be less than $3,650. It is definitely more than that. So Stacy and Herbert are going to be able to file married filing separate or married filing joint, but they do not have a dependent. Not a qualifying relative, not a qualifying child. Number 7, Sam is single and the kindly grandfather who provided over half the support for his daughter, Sally, age 22, and her son, Ed, age 3. Neither Ed nor Sally live with Sam. Sally was a full-time student for 6 months during the year, and she earned $7,000 of wage income for the year. Well, the deal is that Sally is not going to be a qualifying child or a qualifying relative to her grandfather. And therefore, she is going to be looking at meeting the test for her own son. And her own son will become her qualifying child. And since her son is her qualifying child, he cannot be the qualifying relative of someone else. Since neither Sally nor her child lived with her grandfather, neither of them are going to make him eligible for claiming a qualifying child. And since Ed is Sally's qualifying child, he cannot be the qualifying relative of Sam. So Sam essentially gets nothing. Number 8, Jack, a single taxpayer, provided over half the support of his 13-year-old daughter, Stacy. Even though Jack is the custodial parent, he temporarily allowed Stacy to live all year with her mother, Karen, while he served in the military overseas. Jack continues to maintain a home for Stacy, and she will return to live with him when he returns from his service overseas. Karen works full-time and was divorced from Jack in 2002. The 2002 divorce decree states that Jack is the custodial parent and is entitled to claim Stacy's dependency exemption for all years. Provide filing status and dependency answers for this question as they relate to Jack. Well, that's a mouthful. So what we're looking at in this scenario is multiple situations, and it's best to turn to the answer key and really go through this with you. This is a difficult question. The two important issues that have to be considered are the rules relating to temporary absences and the rules relating to custody of a child between divorced parents. Under the residency test rule, a qualifying child must live with the taxpayer all year, for more than half the year, but there are exceptions for temporary absences and for children of divorced or separated parents. Also, Jack's divorce decree specifically states that he can claim Stacy's exemption. In addition, Jack was away from home temporarily, and the IRS is stating that that residency test is still met if the child did not live with you due to temporary absences, and it specifically states that temporary absences can result from special circumstances, including military service. Jack provided more than half the support of his daughter and maintained a home for her while he was away. So under the rule for temporary absences, she is considered to live with him. He is providing a home for her. She is considered to live with him. And essentially also when we get into the rules relating to divorce decrees, he wins under those rules. So ultimately, Jack will qualify as head of household, and Stacy is his qualifying child. He will be able to claim the child tax credit for her since she is under age 17. Now let's look at number 9. We're just going to change things a little. Assume the same facts as in problem 8, except the divorce decree does not state who the custodial parent is. Karen has not signed Form 8332. Provide the filing status and dependency answers for this question as they relate to Jack. So we're still talking about Jack, but we've just changed the scenario a little bit. There's no divorce decree awarding him the dependency exemption or even custody. So Jack will file as single in problem number 9. He will not claim a dependency exemption for Stacy or the child tax credit. Stacy is away from home due to special circumstances, and as such, she should be considered to still be living with Jack while he is away serving in the combat zone, or in the military rather. However, IRS rules relating to divorced and separated parents have to also be considered. Stacy meets all of the qualifying child tests for both Jack and Karen. This means she is the qualifying child of both Jack and Karen. IRS rules governing divorced or separated parents require the divorce decree to specifically state that Jack is entitled to claim the exemption. And since question 9 states that the decree does not include this information, IRS is going to turn to another rule. And that rule is summarized on page 27 of Pub 17. And it says that you are essentially going to look to see who that child lived with the greater part of the year, and ultimately it would be with the mother, Stacy. Okay, so let's move on to the next topic of the day, which is the Session 2 quiz. So at this point, you should push pause, go to the Learning Management System, and take the Session 2 quiz, which is located inside the Test tab for Session 3. And when you have finished taking the Session 2 quiz, please resume playback of this video, and we will begin Session 3 lecture from the Session 3 manual. Okay, by this point, you should have finished taking the Session 2 quiz. If not, please pause playback so that you can finish the Session 2 quiz. But if you are finished with the Session 2 quiz, let's get started with Session 3. Session 3, we're going to be getting into some areas that are probably going to be a lot easier for most people. Many people are very confused in an overwhelming way by filing requirements, filing status, and dependents. So if you're feeling a little bit confused on those topics, you're not alone. And we will revisit those topics again in Session 4 when we do a review of the Session 2 quiz. But for today, we're moving on to the Session 3 topic. And the Session 3 topic is nice, simple stuff like income. And not even complicated types of income at that, simple income. We're going to talk about wage tips and other earnings, taxable refunds, alimony and unemployment, gambling winnings, and the foreign earned income exclusion. Here is your reading assignment for today. And let's move on to page 2 now of the manual. Actually, the bottom of page 1 of the manual, rather. Beginning with wages, salaries, and tip income, and a concept. Who is an employee? An employee is a person who performs services under the direction and control of an employer. Remember this simple rule of thumb. If you are told where to work, when to work, and how to work, then you are probably an employee. It does not matter if you work from your home or use your own tools. What matters is whether your employer controls the method and manner in which you provide services. I'm going to give you some illustrations here, and then we're going to think about this a little bit. Number 1, you work for XYZ company as a secretary. You are told what hours to work and how and where to perform your duties. You are an employee, and your employer should withhold Social Security taxes and Medicare taxes and income taxes and then issue you a W-2. Number 2, assume the same facts as in illustration 1, except that you are self-employed as a secretarial service provider. You market your business to many different clients. You employ a staff of secretaries whom you send to work at various companies. You have control over where and when you work. Sometimes you perform secretarial services for your clients when one of your own employees calls in sick. Because you are in control of your own work and your own business, you are not an employee. You are self-employed. Number 3, you are a nanny. You are responsible for the care of 2 children at Mrs. Jones' home. You report to work 3 days per week. Mrs. Jones tells you how to care for her children and when to care for them. You are an employee of Mrs. Jones. And if she pays you more than $1,700 for the year, she is required to issue you a W-2. You'll see a little bit of an asterisk there and then a box at the bottom. I just want to point out that that $1,700 rule applies only to household employees. All other employees must receive a W-2 if they are even paid $1. So it's a special limit rule there that essentially means that if you hire a few babysitters to come in and take care of your kids so you can go out for the evening, you're not going to have to worry about issuing them W-2s. But if you get into a definite situation where you essentially have a nanny coming to the house on a regular basis to watch your kids, and you're paying that person $1,700 or more for the year, a W-2 does have to be issued. And number 4, assume the same situation as in number 3, except that instead of going to the home of the parent brings the children to your business. So Mrs. Jones brings her 2 children to your home 3 days per week. You decide where and how to care for these children. That makes you self-employed. So why am I giving you these illustrations, and why am I even discussing the definition of an employee? Well, we're getting into the concept of wage income and how we report wage income on a return. And there is a frequent law that is broken, or a law that is broken frequently. And that law is employment laws. And it's expensive to hire employees. The reason it's expensive is that when you hire an employee, you have to adhere to minimum wage rules. You have to pay payroll taxes on them. You might have to carry workers' compensation on them. You might be worried about having to deal with OSHA requirements for work hazard, workplace safety and so forth. So it can be very tempting for an employer to say, oh, well, we don't really have an employee. Everyone who works for us is an independent contractor. And in that way, the employer would get off with not having to pay payroll taxes and all of the other expenses that are a legal requirement. So the reason that there are definitions of employees is because a person cannot just decide that they don't want to treat a particular person as their employee. And they can't go over to an employee and say, hey, employee, I'll only hire you if you agree to be paid on a 1099 miscellaneous. I'm not going to give you a W-2. And the employee is saying, like, I'm so happy to have a job, I'll agree to anything you say. And so an employee and an employer cannot between them agree to change or violate payroll laws. The laws are what they are. And as tax preparers, we frequently have clients come into us who have received 1099 miscellaneouses where they should have received W-2. And on the flip side of it, we may do tax returns for a business owner who we see is paying out 1099 miscellaneouses where they should in fact be issuing payroll. So it's our job as preparers to really give advice not just to the employee, but also to a business owner if we happen to be working with that business owner. Let's look at a W-2 now, actually, and the W-4 form that tells an employer how much income tax to withhold when that W-2 is issued. So this is a W-2. And when you get a job and work for an employer, the employer will give you a form W-4. That W-4 tells the employer how much tax to withhold for you. So when you start a new job, you fill out the W-4 and you give it to your employer. Form W-4 includes 4 types of information that your employer will use to figure your withholding and the amount of tax to hold out of each paycheck. Whether to withhold at the single rate or at a lower married rate. How many withholding allowances to claim, and each allowance reduces the amount that is withheld. Whether you want to have additional amounts withheld, and whether you are claiming an exemption from withholding. There are restrictions that apply. It is important to read the instructions for Form W-4 and to fill it out correctly. An incorrect Form W-4 can result in too much or too little tax withheld. You should refer to Publication 919 for more information. Well, Form W-4 has a worksheet up here. It's called the Personal Allowance Worksheet. And then page 2 of Form W-4 is more worksheets that you use to figure out the number of allowances to claim. Rather than read the worksheets to you, though, I'm just going to summarize this form. This should be one of the simplest forms out there. A person is hired on a job. They may not even be literate. They're a laborer, an immigrant to America with very poor English. Or you could have a college-educated professor. Either way, Form W-4 should be simple, and yet I've seen it confuse college professors, let alone people who do not have education in tax law or college professor level educations. So why is the form confusing? Well, some people read the instructions and get confused. Some people just jump down to the form and fill it out. And let's look at what the form says. It says provide your name, your social security number, your address, and then check one of these boxes. Single, married, or married, withhold at the higher single rate. Well, most people who are married are going to gravitate to married and check that box. And therein lies the problem. Even if you're single and you check the single box, you still have to worry about what goes here on line 5. So let's just think conceptually what this form is trying to do. When you file a tax return, you get maybe to claim your personal exemption if you're not the dependent of someone else, and you get to claim your standard deduction, maybe, if you're entitled to a standard deduction That is, say you're single and you're allowed one. All right. Well, what happens, say, if you work more than one job? Well, if you file a W-4 at one job and claim that you are single and that you're entitled to one exemption, that job is not going to know if you have another job where you have filed the same form and claimed the same exemption. And remember that you're only allowed to claim one standard deduction when you file and one personal exemption when you file unless you have dependents. So you have to be thinking logically about what the purpose of this form is and how it impacts the rate of withholding. Life's pretty simple if you have one job all year and you're single. Then you would check single and either enter one exemption for yourself, 0 exemptions for yourself, or 2 exemptions for yourself. If you read the instructions, they may tell you to enter a number as high as 2. Well, if you enter 2, you're essentially saying that when I file my return, I'm going to get an exemption for myself plus at least one other exemption. And the likelihood of that is small, unless maybe you have other credits, say education credits or some special deductions. So ultimately, the average person will file as single, will be allowed to claim one exemption for themselves when they file. And therefore, if you work more than one job, you should enter on the Form W-4 for both jobs as thinking in mind the income and deductions from both jobs. But both jobs are not going to know about each other in terms of the W-4, and nowhere on the W-4 does it ask what's going on with the other job. So this is a very long-winded explanation of what should be the most simple thing. But as a tax preparer, when you are giving advice to a tax client on how to fill out this form, you should be thinking about how the form relates to the tax return. And ultimately, W-4 should be filled out to give them one filing standard deduction for themselves and one personal exemption for themselves, and no more than that. If they are married, this box here assumes the spouse does not work. If the spouse does work, then you'd better check this box, because again, if the spouse is working and that spouse fills out their own W-4 and claims their own deductions on that W-4, when you file the return, both of you will have claimed deductions for each other on your separate W-4s. That means that you will under-withhold on both jobs, and ultimately when you file, you're going to have a boatload of money. I'm going to move on now to page 5 of the manual, wages and how they get reported on the tax return. You report all employee compensation as income from wages. Employee wages include salaries, tips, bonuses, awards, commissions, allowances, severance pay, sick pay, and the value of fringe benefits. Income from wages received and income from payroll advances for services yet to be performed should be reported in the year you receive payment. There are some important things that you should know about W-2. W-2 is the document on which wages are reported. And here we have a W-2 right on the screen in front of us. And what gets reported, or what do you need to know about the W-2? Well, number one, all compensation which you receive for services that you provided to your employer or employers during the year should be reported by your employer or employers on a W-2, or more than one W-2 if there's more than one employer. By law, all employers are required to issue these documents to employees by January 31. When issuing a W-2, an employer will normally mail 3 to 4 copies of the form to the employee, although in the modern day, many employees are expected to log on to employee databases with the employee companies and download the W-2s. Or sometimes the employer might email the W-2 to the employees. So we're increasingly getting electronic there. But ultimately, the employer is required to issue the W-2 by January 31st of each year. And the employer is supposed to give 3 or 4 copies of the W-2 to the employee. Now, the employer also has to mail or electronically file a copy of the W-2 with the Social Security Administration. The Social Security Administration then records the information from the W-2s into its files. The reason Social Security receives W-2s is they are interested in tracking Social Security and Medicare taxes that have been paid. When the Social Security Administration is finished processing the W-2, it then forwards the data on the W-2 to the IRS. It can take up to 18 months from the time Social Security Administration receives a W-2 before the IRS computers are able to match an employee's reported earnings against income reported on his or her tax return. I think that window or time frame is tightening, but these are historical figures that we've worked with for many, many years. So essentially what happens is when you file, as an employer, you file your W-2. You have to give it to your employee. And then you electronically submit, in most cases, that W-2 to the Social Security Administration. The Social Security Administration then turns around and sends that information to the IRS. So there's a period of time where the employee has their W-2 and will be filing tax returns, during which the IRS is not able to match those tax returns against any direct information. And so it is after return has been accepted that the IRS will typically make adjustments, because it's not able to make adjustments at the time the return is actually filed, because it doesn't have the information to match against, because Social Security didn't release it yet. All right, box A, and we're going to be taking the W-2 now and looking at one box at a time, beginning with box A right here. So on the screen next to the manual, I'm pointing out a W-2 to you. And the first box we're looking at is box A. What is the purpose of that box? Well, your employer will put your Social Security number in that box. As tax preparers, you should be aware that sometimes the number in the box is not correct. If the number in the box is wrong, the employee and not the tax preparer should draw a line through the Social Security number that is shown in this box and handwrite in the right number. Also, the employee should immediately notify the employer of the error so that the employer can fix the error and submit a corrected W-2 to Social Security. Box B is where the employer identification number goes. The employer identification number is a 9-digit number. It usually goes 2 digits followed by a hyphen and then 7 more digits. Every employer is required to have an EIN, and the EIN is entered in this box. Box C. Box C is where the employer's information is entered, generally their address and their name. Box D is a control number. This is for the use of the employer only, and it doesn't really matter what number's in there. You can disregard it for tax purposes. Box E, enter the employee's name, address, and zip code. Your name on your Social Security card should exactly match the name on your tax return. And it should also exactly match the name on your W-2. If you change your name, you must notify Social Security Administration of your name change and request a new Social Security card. If you file your paper tax return using a name that is different than the one on your Social Security card, the IRS will issue you a letter requesting you change your name with the Social Security Administration. If you file your electronic tax return using a different name than the one on your Social Security card, the IRS will reject the tax return. This means your return will not be filed until you resubmit it with information that is a correct match. So ultimately, it is possible for an employer to put a different name on the W-2 than you file with, but the name that you file with must match the name on your Social Security card. And if there is a mismatch between your W-2 and your Social Security card, then you either need to change your name with your employer, or you should be going to the Social Security office and changing your name there. But a difference between the W-2 and the name on your Social Security card will not prevent you from filing, but you must use the same name on the tax return that is on your card. And ultimately, that could end up being the situation where you're filing a tax return where the name on the tax return is not a match to the W-2. Box number 1, wages, tips, and other compensation. We're right up here. All taxable compensation you receive from your employer should be reported in this box, and this includes wages, salaries, severance pay, sick pay, vacation pay, the value of any car allowance, other allowances, bonus awards, taxable moving benefits, or any other fringe benefits you may have received during the year. Box 2, federal income tax withheld. Federal income taxes withheld from your paycheck are reported here. You should control the amount of your tax your employer withholds by completing the Form W-4 that I just showed you a few minutes ago at the time you get hired. The more dependency exemptions you claim on your W-4, the less tax your employer can withhold or will withhold. Your employer should also withhold less tax if you checked married rather than single on that Form W-4. Social Security wages. Social Security wages may be reported in the same amount or in a different amount from Box 1 wages. It's common for the Social Security wages to actually be more because you are able to take certain salary deferrals for 401k plans or 403b plans that reduce your taxable income reported in Box 1. Also, certain professions such as clergy, police officers, and others may not even have Social Security wages showing in Box 3 at all. Box 4, Social Security tax withheld. You are required to pay Social Security tax on the first $106,800 of your earnings. Your employer should withhold 6.2% of your Social Security wages for paying your share of Social Security tax. Your employer is required to match your Social Security withholdings by paying an additional 6.2% tax for you. The Social Security Administration will allocate these funds to your account, and the information is used to determine your future benefits from Social Security. For 2011, the Social Security rate drops by 2 percentage points for employees. This means the employer should withhold only 4.2% of your Social Security wages, but that's for 2011 only. So that's the box that we're looking at right here, how much Social Security tax is being withheld. So in 2010, it's 6.2%. When you look at 2011 W-2s, the amount's going to be 4.2%. Box 5, Medicare wages and tips. Your earnings which are subject to Medicare tax are reported here. Medicare withholdings are 1.45% of the Medicare wages. Box 7 is Social Security tips. If you receive tips, you should report your tips to your employer. Your employer should then withhold Social Security tax, Medicare tax, and income tax from your wages. Tips are reported with Box 1 wages, but are not lumped with Social Security wages in Box 3. So ultimately, if you work for tips, your wages plus your tips get reported in Box 1, but the Social Security wages are reported in Box 3, and the Social Security tips are reported in Box 7. And then Box 7 plus Box 3 multiplied by 6.2% will give you the number in Box 4. Box 8, allocated tips. Under the law, certain types of restaurants and bars must report tips in proportion to their gross receipts from food and beverage sales. If the percentage of tips received is too low, an employer must allocate tips to employees who have reported less than a certain percentage of tips. Allocated tips reported in Box 8 have not been included in Box 1. All employees who receive tips are responsible for tracking the tips they receive on a daily basis. If an employee has no proof of tips received, that is in the form of a tip log, they will be required to accept this allocation and pay tax on the tips reported in Box 8. You should include allocated tips with wages on your return, and you should complete Form 4137 to accurately calculate your share of Social Security and Medicare taxes that are owed on your allocated tips. So allocated tips are reported right here in Box 8. The next box we're looking at is Advanced EIC. And the Advanced EIC has expired. 2010 is the last year you will see that box or a number in it. It has to do with the Advanced Earned Income Credit. And if you received Advanced Earned Income Credit, the amount you see in Box 9 is going to be addition to tax shown on your tax return. So let me just show you what I mean real quick. I'm going to open up a 1040 form and show you what to do with that. So here is the 1040 form. I scroll down to page 2 of the form, and I am looking at a very specific line, which is line 59. Line 59 on the return shows the amount from your Form W-2 Box 9, and if there's a number in Box 9, whatever it is, you will enter it on line 59 and check Box A of line 59. Box 10, Dependent Care Benefits. If your employer offers dependent care benefits, you can decrease your taxable income in Box 1 by wages, or in Box 1 wages, by submitting receipts to your employer. Any benefits you receive up to $5,000 or half that amount for married filing separate are not subject to income tax, providing you have qualifying dependent care expenses. If you receive dependent care benefits, you must file Form 2441 to report the name, address, and identification number of your dependent care provider. We'll get more into Form 2441 when we get into the Child and Dependent Care Credit much later on in our course. Box 11, non-qualified plans. Amounts reported here are included in Box 1, wages. Box 12, amounts reported here are identified by code letters, and you should refer to the backside of the employee copy of the W-2 for definitions of these particular codes and letters. Here are the codes that could appear on the W-2 and the definitions that go with them. The most common definitions that we will come across are item number C, the cost of group term life insurance over $50,000. D, effective deferrals to a 401k plan. E, effective deferrals to a 403B plan. Those are the most common ones I see. Also, J, non-taxable sick pay, is one that I regularly see. On the next page, P, excludable moving expense reimbursements that were paid directly to the employee by the employer. That's a code I see sometimes. Q, non-taxable combat pay. And V, income from the exercise of non-statutory tax options, or stock options, I should say, rather. So exercising of statutory, non-statutory stock options means that you have taxable income from the disposition of those options, and that would trigger a code V on your W-2. So there are other codes. I'll leave you to read those in your own time. Moving on, box 13, you'll see that there are 3 boxes. The first box is for statutory employee, the second box is for retirement plan, and the third box is for third-party sick pay. Those boxes are important and should be referred to when calculating the retirement savings contribution credit, IRA deductions, and certain other modified adjusted gross income calculations. If the statutory employee box is checked, you are eligible to deduct employee business expenses on Schedule C. Schedule C is normally used to report self-employment income and expenses only. By deducting expenses on Schedule C, statutory employees do not have to itemize their deductions to claim employee business expenses, and their expenses are not reduced by the 2% of AGI limit that normally applies to employee business expenses. Box 14, this box right here can mean anything. It is not an IRS use box. It is strictly up to the use of the employer, and all employers use it in all different ways. So if you want to know what something in box 14 means, then you would need to ask the employer. Sometimes it's self-evident because the abbreviation or coding in it is really clear. But examples of things that might be reported in box 14 by an employer include union dues, moving expenses, and health insurance premiums paid. Some employers also report certain state and local taxes in that box, such as SDI premiums for California employees. Box 15, state employer and state ID number. This box indicates which state your income tax and state withholdings have been reported to. So the state ID code, such as CA for California or MN for Minnesota, would go in this space right here. And then the employer state ID number goes in this box. And then, of course, state wages. You should be aware that employers make mistakes. If you believe your wages and taxes have been reported on the wrong state, then you should request a corrected W-2 from your employer. For example, you worked all year in the state of Oregon and you are a resident of Oregon. Your employer is based in New York and issues you a W-2 with box 15 showing New York. If you were not a resident of New York and did not work in New York during the year, your employer is absolutely incorrect in indicating that you are a New York employee. You are an employee of a New York company, but you're not a New York employee. And the withholding and the payments on the income should be going to the state that you are working in. And that would, of course, in our example, be Oregon. And you could take that same example and apply it to any other state. Box 16, state wages, tips, etc. So we're looking at this box right here. State wages are reported here, generally are the same as the amount shown in box 1, although if you worked for 2 or more states during the year, the wages should be divided. And the total of wages paid to you in all states that you worked in should equal the amount in box 1 wages. Number 17, state income tax withheld. State income tax withheld is reported here, and you want to make sure, of course, that you apply that withholding credit to the state that actually receives the tax withholdings. Box 18, local wages, tips, etc. If you worked in a city or a locality subject to local taxes, your wages subject to these taxes is shown in this box. Box 19, local income tax withheld. That would be the amount of withholdings paid to the locality you are working in or living in. Next item of the day is taxable fringe benefits. A fringe benefit is a form of pay for the performance of services. Fringe benefits are taxable and must be included in employee pay unless the law specifically excludes them. You generally must include fringe benefits you received in your income unless the benefits are non-taxable. And following are examples of taxable fringe benefits that must be included as income in Box 1 wages. Free use of a company car, freights on aircraft provided by your employer, free or discounted commercial flights, free vacations, discounts on property or services, memberships in country clubs or social clubs, tickets to entertainment or sporting events. In general, your employer must include the fair market value of benefits to the extent you were not required to pay for these benefits. The value of taxable fringe benefits is reported in boxes 1, 3, and 5 of your W-2. There are special rules governing how your employer values certain fringe benefits. See Publication 15B for more information. This is a good point to just refer you to the LMS. Anytime I tell you that you should refer to a publication, that publication is typically going to be available to you in one of two places. So I'm just going to navigate to the internet right here, and I'm going to share a website with you. So I'm just going to navigate to a couple of different places for you. The first one is our website, and I'm just going to our website basically because I want to get into the LMS. And I'm going to get myself into session 1, or actually we're in session 3 of the basic tax course today, aren't we? So I'm going to just pop in there, and I'm going to go to the Forms and Publications tab, go down to the file cabinet drawer, and actually today for our classwork assignment, if you haven't already printed these forms, you're going to need to. We're going to be doing some classwork assignments that involve forms today, specifically Forms 1040 and Form 4137. And of course, those forms are located in the Forms folder. They're all in numerical order. And the publications are located in a publication folder. And this folder is filled with a variety of publications. I don't see publication 15B listed here. I'll go out of my way to make sure that gets added so that that is a resource that you can refer to. But the fact that a publication is not in here should not worry you, because the next place that you can go to find publications is actually the IRS website. So I'm just going to go to irs.gov. And if I want to find a particular publication that has not been loaded into the learning management system, I simply go to the IRS website, and I'm going to type in publication 15B. And they've already got a 2011 publication 15B up. That's okay. They also have it in HTML format. HTML can be easier to read on the internet. You don't have to load it. And if you go into this publications, you're going to be looking at the types of fringe benefits that an employee might receive. And there is a big long list of them. And the question is, are these taxable to the employee, or are they tax-free to the employee? And they actually have a tax treatment table here that you could refer to. This is all really important stuff. The IRS does intend to ask some questions about the taxability of taxable fringe benefits, and that is asking you to identify which benefits are taxable and which are not. I don't think that they'll go into in-depth with a lot of questions on fringe benefits, but you should take some time to review publication 15B, if nothing, just for the sheer benefit it will bring you as a tax preparer, understanding that publication and what it refers to. Okay, let's move on to the next topic, which is tip Okay, moving on to the next topic of the day. All tips you receive are income and are subject to income tax. If you receive tips, you should keep a daily tip record, report tips to your employer, and report all your tip income on your tax return. So what is a daily tip record? Well, it's a record of your tips, and you can keep this record in two different ways. You can write the information about your tips into a tip record or a tip log. The other way is to keep copies of documents that show the tips you received. Examples include restaurant bills, credit cards, and charge slips. If your employer uses an electronic tip record, you must receive and keep a paper copy for your records. So why report tips to your employer? Well, the first reason is that your employer will be able to withhold income, Social Security, and Medicare taxes on the tips for you. 2, your employer can correctly report your earnings to Social Security Administration for when you retire and start drawing on Social Security. And 3, to avoid the penalty for not reporting tips. That is, you're required to, and you're in trouble if you don't. Allocated tips. Allocated tips are amounts your employer assigns to you in addition to tips you reported. Your employer is required in certain situations to allocate tips to you if you fail to report tips totaling 8% or more of your food and beverage sales. If your employer allocates tips on your W-2, you must report these allocated tips on your tax return. You should include Box 8 allocated tips with other wages you report on your tax return. If you disagree with the allocated tips that your employer assigned you in Box 8, you can dispute the allocation if, and only if, you keep a tip record. If you keep a tip record, you should include the amount of tips you received but did not report to your employer on the wage line of your Form 1040. So let's just take a look at what we mean by that. I'm going to open up the 1040 form again. Come here, 1040. There we are. Okay, so I've got 1040. I'm just going to scroll up to page 1 of the form rather, and line 7. Line 7 is where you enter your wages, salaries, and tips. So if you receive allocated tips, those allocated tips are going to show up in Box 8. Whatever number is in Box 8, you will add that to the number in Box 1, and the total of those two amounts will go on line 7. The exception to that rule is if you keep a tip log, and that tip log proves that you did not receive the allocated tips in Box 8. If you can prove you did not receive those allocated tips, you can enter a lesser amount in Box 7. But of course, the amount you enter in Box 7 should not be less than the amount in Box 1 plus any tips that you did receive and did not report to your employer. So here is an illustration. Betty received a W-2 from her employer showing the following information. Box 1 wages of $7,000. Box 3 wages, Social Security wages of $4,000. And Box 7 Social Security tips of $3,000. So 7 plus 3 equals Box 1. She also has a number in Box 8 of $4,500 showing allocated tips. Now, Betty was very careful throughout the year, and she kept a tip record. Her tip record shows she received $5,000 total tips for the year. Betty's tip record is proof of the amount of tips she actually received for the year. So even though her W-2 indicates that she received $7,500 in tips, that is the $4,500 in Box 8 plus the $3,000 in Box 3, she's not going to have to pay tax on all $7,500 of tips. Instead, she's only going to have to pay tax on the tips that she received but did not report to her employer. So the amount that she will ultimately enter on line 7 of her tax return is going to be $9,000. That will be equal to the amount reported in Box 1 as wages, plus the amount of tips that she received did not report to her employer, and that's where the 9 comes from. Betty should have reported all $5,000 of tips she received for the year to her employer. Since she did not, she must report her tips or unreported tips on Form 4137 and use that form to calculate and pay the amount of Social Security and Medicare tax she owes on the unreported tips. So here is her W-2. Remember, you have to be really thinking about what I'm saying here. I'm telling you that she had allocated tips of $4,500, but that number is wrong. She in fact had tips of $5,000, but she only reported $3,000 to her employer. Since she only reported $3,000 to her employer, she's going to add to that $3,000 an additional $2,000 of tips received that were not reported. And the $2,000 of tips received and not reported are added to line 7 wages on the tax return. So we end up with 7 plus 2 equals 9 being reported as wages on the tax return. The allocated tips are taxable unless she can prove she didn't get them. But since she kept a tip log, Becky can prove she didn't get them. So instead of reporting allocated tips of $4,500, she's going to report unreported tips of $2,000, and she will fill out Form 4137 to do that. So how do you fill out Form 4137, and what is the purpose of it? Well, if you must report allocated or unreported tips on your tax return, you use the amount on your Form W-2, Box 8, or your unreported tips from your tip record to calculate the additional Social Security and Medicare taxes that you owe. And you use Form 4137 for those calculations. On Form 4137, in column C of line 1A, you report the amount of tips you received for the year, and in column D, you report the amounts that you reported to your employer. The difference between those is the unreported amount. The unreported amount is subject to Social Security and Medicare tax. But you also have to look to see whether or not your total wages for the year exceed $106,800, because if they do, you won't owe the Social Security portion. But of course, Betty is way under that number, so she will have to report and pay Social Security tax on the $2,000. She takes $2,000 and multiplies that by 0.062 and by 0.0145. And those two percentages give her $124.29 respectively. You add those two numbers together and you get $153. That $153 carries over to page 2 of Form 1040. You check box A for Form 4137 on line 57 and enter $153 on the line. Then, of course, she did have a W-2 showing federal income tax withholding. She's eligible for a Making Work pay credit. So ultimately, she will receive a refund. Now, the $2,000 of unreported tip income generates Social Security and Medicare tax of $153. Question for you, though. How much tip income would Betty need to report on her tax return and on Form 4137 if she did not keep a tip log? Well, if she did not keep a tip log, this number on line 4 would be the $4,500 figure showing on the W-2 in box 8, rather than the much smaller number of $2,000. And the corresponding income tax and Social Security Medicare tax would go up. Next topic of the day is taxable scholarship and fellowship income. A scholarship or fellowship is only tax-free if you are a candidate for a degree at an eligible educational institution and you use the scholarship or fellowship to pay qualified educational expenses. For purposes of tax-free scholarships and fellowships, the following expenses qualify: tuition and fees required to enroll at or attend an eligible educational institution, and course-related expenses such as fees, books, supplies, and equipment that are required for the courses at the eligible educational institution. These items must be required of all students in your course of instruction. Expenses that do not qualify as tax-free are room and board, travel, research, clerical help, or equipment and other expenses that are not required for enrollment in or attendance at an eligible educational institution. Taxable scholarships or fellowships are reported on Form 1040 or 1040A line 7. If the taxable amount was not reported on a W-2, you should also enter SCH and the taxable amount on the dotted line next to line 7. So let me just show you Form 1040 to see what we mean by that. So looking at Form 1040 here, I'm going to just blow this up a little bit. We're concerned with line 7 and what we do with taxable scholarships when we're making entries on that line. Ultimately, if we have a taxable scholarship, the amount of the taxable scholarship gets entered on the line, and if that scholarship was not paid on a W-2 or was not reported on a W-2, then let's just suppose the taxable scholarship is $5,000. I'm including that on line 7, and if it was not reported on a W-2, then on the line next to line 7, I will type SCH on the line, on the dotted line, next to line 7, and it would look just like that. And if you're using tax software will often do that type of entry for you. So if you see your software putting a code anywhere on a dashed line on any of the 1040 lines, those codes typically come from IRS instructions. Next topic is the foreign earned income exclusion. If you are a U.S. citizen or a resident alien, your worldwide income is generally subject to U.S. income tax regardless of where you are living. If you lived in a foreign country, you are subject to the same income tax filing requirements that apply to U.S. citizens or resident aliens living in the United States. It does not matter how long you have resided outside of the United States, nor does it matter if you pay taxes to the foreign country you are living in. As a U.S. citizen or green card holder, you are required to file a U.S. tax return and pay tax on your worldwide income if your income equals the minimum amount for your filing status and age. Now, there are some expatriation tax provisions that apply to U.S. citizens who have renounced their citizenship and long-term residents who have ended their residency. If you want to know more about these particular situations, you should refer to Chapter 4 of IRS Publication 519. If you worked and lived outside of the United States for a minimum of 330 full days during a period of 12 consecutive months, you may be able to exclude up to $91,500 of your foreign earnings. In addition, you can exclude or deduct certain foreign housing amounts. You may also be entitled to exclude from income the value of meals and lodging provided to you by your employer. Requirements to claim this exclusion. To claim the foreign earned income exclusion, the foreign housing exclusion, or the foreign housing deduction, you must meet all 3 of the following requirements. Your tax home must be in a foreign country. You must have foreign earned income. That means income from a job or self-employment. And you must either be a U.S. citizen who is a bona fide resident of a foreign country or countries for an uninterrupted period that includes an entire tax year, or a U.S. resident alien who is a citizen or national of a country with which the United States has an income tax treaty in effect and who is a bona fide resident of a foreign country or countries for an uninterrupted period that includes an entire tax year, or a U.S. citizen or resident alien who is physically present in a foreign country or countries for at least 330 full days during any period of 12 consecutive months. Waiver of the minimum time requirements. The minimum time requirements for bona fide residence and the physical presence test can be waived only if you leave a foreign country because of war, civil unrest, or similar adverse conditions in that country. So sometimes I get questions like, well, I had to leave the country early because someone in my family got sick, or I got laid off, or there was an emergency. Those are not exceptions to that 330-day rule. Only circumstances which essentially cause you to leave, like war or civil unrest, can be an exception to that rule. So who can claim this exclusion? If you've worked in a foreign country, you may qualify to exclude up to $91,500 of your income from U.S. taxation. If you are filing a joint return and your spouse worked, your spouse may also be eligible to exclude his or her foreign earned income. To claim the exclusion, you must meet at least one of the following tests: the bona fide residence test or the physical presence test. Let's talk about the bona fide residence test first. To meet the bona fide residence test, you must have established a bona fide residence in a foreign country. You must show the IRS that you have been a bona fide resident of a foreign country or countries for an uninterrupted period that includes an entire tax year. The IRS decides whether you are a bona fide resident of that foreign country, largely on the basis of the facts and information that you report on Form 2555. Physical presence test. This is the alternative test. You need to meet either the bona fide residence test or the physical presence test. And actually, in most situations, I just default to the physical presence test because it's much easier. You meet the physical presence test if you are physically present in a foreign country or countries for 330 full days during a period of 12 consecutive months. The 330 days do not have to be consecutive. Any U.S. citizen or resident alien can use the physical presence test to qualify for the foreign earned income and foreign housing exclusions. The physical presence test is based only on how long you stay in a foreign country or countries, and the test does not depend on the kind of residence you establish, your intentions about returning, or the nature and purpose of your stay abroad. 330 full days. Generally, to meet the physical presence test, you must be physically present in a foreign country or country for at least 330 full days during a 12-month period. The 330 days can overlap 2 different years. This means your 330-day period could begin in 2010 and end in 2011. Figure 4B from IRS Publication 54 illustrates how to count the days of presence in a foreign country. And they're essentially showing a tax year that begins in 2009 and ends in 2010. And in that situation, you could meet the the physical presence test for both 2009 and 2010. But for each of the years, you may only be allowed a partial exclusion if you were not gone from the United States for all 330 days available for 2010. You do not meet the physical presence test if illness, family problems, a vacation, or your employer's orders cause you to be present for less than the required amount of time. So in summary, to claim the foreign earned income exclusion, you must meet the bona fide residence test or the physical presence test. You must have earned income from wages or self-employment, and you must be a U.S. citizen or a resident alien. Refer to Figure 4A from IRS Publication 54 to determine if you are eligible to claim the exclusion. IRS Publication 54 does provide Figure A, which you can use to determine whether or not you meet these tests. And it's essentially a flow chart that goes through and applies the tests. You follow it through, and ultimately you either end up with yes, you can claim the foreign earned income exclusion, or no, you cannot. If you establish that you can claim it, how do you claim it? To claim the foreign earned income exclusion, you must complete Form 2555 or the short version 2555EZ. You use the form to show that you meet either the bona fide residence test or the physical presence test. It also shows the amount of foreign income you have, the amount of foreign earned income or housing allowance you are allowed to exclude from your income, and then you enter the amount of exclusion that you are claiming and allowed to claim as a negative number on Form 1040, line 21. Write 2555 and the amount of your exclusion in negative as a negative number on line 21. Here is an illustration of what it will all look like. Ozzy Sunshine is a U.S. citizen who moved to Perth, Australia on June 30, 2010 to begin work at Down Under University as a professor. He had $50,000 of income earned inside the United States and $50,000 of income earned in Australia. Since Ozzy was outside of the U.S. for less than a full year, he must prorate his exclusion based on the number of days he resided outside of the United States. Calculate his earned income exclusion as follows. You begin with the maximum amount that he's allowed to exclude for the year, $91,500. Then determine the percentage of the exclusion that Ozzy is allowed to claim. Days of physical presence outside of the U.S. is 184 out of 365 days, or 50.4%. We multiply 50.4% by the maximum exclusion, and we get $46,116. We determine the amount of the foreign income, that was $50,000, and he can exclude the lesser of those two numbers. In this case, $46,116. He's going to enter $46,166, actually $116 on Form 1040, line 21. So we go over to Form 1040, line 21, and we enter that amount as a negative number. Now, just for reference, we are providing you with a copy of Form 2555EZ. The completion of the form and any focus on the form is well beyond the scope of this course. We don't want you devoting any amount of time to wondering how and why we filled it out. But it is entirely possible that on your first day as a tax preparer, you're going to have a client walk in the office, sit down in front of you and say, hey, yeah, I was overseas for a couple of years and I just got back and I had some income. And already as a tax preparer, you should know that that client would need to report his worldwide income and could possibly qualify for the foreign earned income exclusion. And then at that point, you should be seeking assistance from a more experienced person in your office to help you with that return. And of course, we have 184 days, 50.4%, and there's our $46,116. Alrighty, taxable refunds is the next topic of the day. Generally, you will only need to worry about claiming your state refund as federal taxable income if you itemized your deductions for the year on which that refund is based. Additionally, you must have derived a tax benefit from claiming state taxes paid as an itemized deduction. Let's look at the tax benefit rule. This does throw tax preparers off all the time. A refund will only be taxable if you received a tax benefit from deducting it in a prior year. That is, you were able to reduce your tax liability because you claimed state taxes paid as an itemized deduction. When is your federal income tax refund taxable? Well, your federal tax refund is not taxable on your federal return. Refunds of federal income tax are never included on your federal income tax return because federal taxes are not deductible on your federal return. In certain situations, your federal refund might be taxed at the state level, and you should research the state tax laws specific to your state to determine if and when your state might tax a federal refund. Taxation of federal refunds is discussed in our individual state tax courses, and we cover state tax law under Oregon and also under California. Any other state, you're really on your own. We don't have other state courses available at this point. Taxability of state income tax refund. If you claimed a deduction on a prior year return for taxes you had withheld or paid to a state, then you must claim any subsequent state refund as income on your federal return to the extent that you benefited from deducting that state tax refund on your federal return for the year claimed. All state governments issue Form 1099-G to report refunds paid. The amount appearing on Form 1099-G may or may not be taxable, depending on whether you received a tax benefit from deducting the state tax on your federal return. Report your state taxable refund on Form 1040, line 10. Also, recovery of mortgage interest and other deductible expenses. As with your state tax refund, you should claim a refund of expenses as income if you previously derived a tax benefit by claiming the expense as a deduction on a tax return in an earlier year. And here's an example. If you claim mortgage interest you paid as an itemized deduction on Schedule A, and then in a later year you received a refund from your mortgage company from overpayment of interest, you must include the refund of interest as income on your tax return. You should treat a refund of interest the same way you treat all other taxable interest income. Alimony, also called spousal support. If your former spouse pays you alimony under a divorce or separation instrument, you must include any payments you received during 2010 as income on your 2010 return. You report alimony or spousal support you received on Form 1040, line 11. So let me just pull up the 1040 form here again. And 1040, we were showing you how to report scholarship income on our last time I had this slide open, so I'm just going to clear these out. And if we scroll down the form just a little bit, we're going to see that line 10 is where we enter taxable refunds, and line 11 is where we enter any taxable alimony that we have received. To be alimony that is taxable, a payment must meet certain requirements. To determine if the alimony payments are taxable, all of the following rules must apply. The payments are required by a divorce or separation instrument. You cannot file a joint return with the spouse who is paying you the alimony. The payment is in cash. Your divorce or separation maintenance decree does not state that the payment is not alimony. You and your former spouse who is paying the alimony do not share the same household. There is no liability to make any payment in cash or property after the death of the recipient spouse, and the payment is not treated as child support. You cannot report alimony you received on Form 1040-EZ or Form 1040-A. Child support. If your divorce or separation instrument specifically designates a payment as child support or treats the payment as child support, then the payment is not alimony. A payment is specifically designated as child support to the extent that the payment is reduced either by the happening of a contingency relating to your child, such as the child becomes employed, dies, leaves the household, leaves school, marries, or reaches a specified age or income level, or can be associated with a time that is clearly associated with the contingency. So, for example, if the divorce decree states that the child support, let's word it differently. Let's say the divorce decree states that spousal support shall be paid until June 30, 2003. And it happens to be that June 30, 2003, actually 2013, let's make it a date in the future, 2013, June 30 is the date that a child will turn age 18, even though the divorce decree refers to the payment as alimony. The contingency on which that payment is made is associated with a date associated with the child. And because it is, then it would be child support, not alimony, and it's not taxable as alimony. Let's look at some examples. Number one, Steve and Sandra Ballard are divorced. Sandra has custody of their 2 children. The divorce decree states that Steve shall pay Sandra $1,500 per month. The decree does not stipulate that any of the payment is contingent on either of the children. The entire payment is considered alimony. Example number 2, Jean's divorce decree states that her husband may pay her the following monthly amounts: $600 spousal support plus $200 child support for each of their 2 children. Jean must report $7,200 of spousal support as alimony on line 11 of her Form 1040 tax return. Her former husband will be allowed to deduct that same amount as an adjustment to income on his return. But the $4,800 of child support that Jean receives from her former husband is not taxable to her, nor is it deductible to her former husband. And there's a note here that child support is always paid before alimony. If a divorce instrument orders the payment of alimony and child support, the child support shall always be considered to have been paid first. If the total child support and alimony payments for the year are less than the amount stipulated in the divorce decree, all payments shall be considered to have been paid towards child support until such support is paid in full, and any remaining amounts shall be applied to alimony. If you would like to know more about this, refer to Publication 504, page 13. And here is an example. John and Jane are divorced. Their divorce decree states that John must pay Jane the following monthly amounts: $600 of alimony and $500 of child support. During 2010, John falls behind on his payments. He makes total payments to Jane of $8,000 during the year. Jane must report $2,000 of alimony on her return as income. The first $6,000 she received was child support and is not included in her income. So the child support is always paid first. She's going to figure out how much child support she received, in this case $6,000. She subtracts 6 from the total of 8 that was paid to her, and the difference of $2,000 is alimony. Here's a summary of the rules relating to alimony. This is for instruments executed after 1984. Payments are alimony if they fall under this column. They are not alimony if they're described under the right-hand column. So a payment is alimony if the payment is required by a divorce or separation instrument, but it is not alimony if it is not required by a divorce or separation instrument. The payment is alimony if both the payer and the recipient spouse do not file a joint return with each other. It is not alimony if they do file together. It is alimony if the payment is in cash, including checks or money orders, but the payment is not alimony if it is not paid in cash, or is a non-cash property settlement, or is the spouse's part of community income, or is to keep up the payer's property. The payment is not designated in the instrument as not alimony, then it is alimony. If it is also not designated in the instrument as not alimony, right? Okay, So the spouses must be legally separated under a decree of divorce or separate maintenance, and they cannot be members of the same household in order for the payment to be alimony. But if the spouses are legally separated under a decree of divorce or separate maintenance and they do live together, then it is not alimony. If the payments are not required after the death of the recipient spouse, then that would be a reason why it was alimony. But if the payments are required to be paid after the date of death, that would mean that it's not alimony. If the payment is not treated as child support and it is required by the divorce decree, then it would be alimony. But if it is treated as child support, then it is not alimony. And if they are alimony, payments are deductible by the payer and taxable as income on the return of the recipient. If the payments are not alimony, then they are not deductible by the payer and they are not taxable as income on the tax return of the recipient. Let's look next at unemployment compensation. Unemployment compensation is reported on a different line. I'm just going to open up the 1040 form again. And now we're moving on down the form to line 19. Line 19 is where you report unemployment compensation on Form 1040, long form. If you're preparing the short form, there should also be an unemployment line on those forms. Generally, any unemployment benefits you receive are taxable on your federal return. If your unemployment benefits are taxable, the state paying the benefits should issue a Form 1099-G to report the benefits paid to you. You should enter taxable unemployment benefits on line 3 of Form 1040-EZ, line 13 of Form 1040-A, or line 19 of Form 1040. If you paid any of your 2010 unemployment benefits during 2011, you should subtract the amount you repaid from the amount you received and enter the net amount on Form 1040, line 19. On the dotted line next to your entry, you should write repaid in the amount you repaid. So let's just show you an illustration of what that would look like. Going back to the 1040 form, let's just suppose that during the year, I received unemployment equal, let's just say you received $7,500 of unemployment, okay? But then you repaid $2,000 of benefits. All right, so how is this going to get reported on the tax return? Just put that where you can read it. There we go. What we're going to enter on the tax return, therefore, is going to look like this. We'll go down to line 19, and we're going to subtract $2,000 from $7,500 and enter $5,500 on line 19 as income. And then what we will do is on the dotted line next to line 19, we're going to write repaid $2,000 so that the IRS is able to see why there's a difference between the amount of unemployment reported on the tax return and the amount shown as paid out by the unemployment department of the state that you live in. Now, if during 2010 you repaid unemployment benefits that you received in a prior year, you do not enter a negative number on line 19. The lowest line 19 that can ever go is 0. If you repaid more than you received, you can claim the difference between what you repaid that is more than what you received as a deduction on Schedule A. And that's on line 23 if you itemize your deductions. For more information about that rule, refer to publication 17, page 89. All right, we're looking at a diagram here of 1099-G. And a 1099-G is simply a 1099 that is issued by the government. All right? And so you would never really see a situation where unemployment and taxable state refunds are reported on the same 1099-G. We just did it for educational purposes for this course. So you're basically seeing here that we've got unemployment of $3,500. We have state taxable refund of $1,800. Assuming that you have established that $1,800 is in fact taxable, that $1,800 would carry to line 10. The unemployment would carry to line 19. Those would add to any other income that you have. And in our illustration here, our filer has $25,300 of income. Gambling winnings. Is the next category. Gambling winnings are reported on Form 1040, line 21. You must include all of your gambling winnings as income on Form 1040, line 21. You will be issued a Form W-2G if you receive any of the following: $1,200 more in gambling winnings from bingo or slots machines, $1,500 or more in proceeds, the amount of winnings minus the amount of wager from Keno, more than $5,000 in winnings reduced by the wager or buy-in from a poker tournament, $600 or more in gambling winnings except winnings from bingo, Keno, slot machines, and poker tournaments, and the payout is at least 300 times the amount of the wager. Any other gambling winnings subject to federal income tax withholding. If you itemize your deductions on Schedule A, Form 1040, you can deduct your gambling losses that you had during the year, but only up to the amount of your winnings. So you remember just a few minutes ago I showed you how you enter repaid on the unemployment line if you had a repayment from unemployment in the same year you received benefits? Well, for gambling, you never enter a negative number or a subtraction on line 21. If you have gambling losses, the only place you enter those is on Schedule A, and all winnings are reported on line 21 in full. Here is a summary of the types of taxable and non-taxable income you might get during the year and how they are reportable on your tax return if they are reportable on your tax return. So this chart lists some of the many types of income that do not have a specific entry line on Form 1040. Many of these items are generally considered to be non-taxable, but if the items are taxable, you need to report your earnings on Form 1040, line 21 as other income or as self-employment or as investment income. So let's look at the non-taxable items first, and then we'll go through and look at the taxable ones. Non-taxable income includes welfare benefits, food stamps, workers' compensation, disaster relief grants made under the Disaster Relief Act, cash repayment on an item that you buy from a dealer or a manufacturer, mortgage assistance payments under Section 235 of the National Housing Act, campaign contributions that are actually spent for campaign purposes, casualty insurance and other reimbursements, child support payments, court awards and damages for personal injury or distress related to such injury, energy conservation subsidies paid by public utilities for the purchase or installation of an energy conservation device in a dwelling, foster care payments you receive for the care of children under age 19 that are placed with you by a government agency or a tax-exempt child placement agency, foster care payments you receive for the care of children under age 19 that are placed with you by a government agency or a tax-exempt child placement agency, difficulty of care payments you receive for the care of 5 or fewer individuals over age 19, gifts and inheritances, Indian fishing rights in place on 3/17 of '88 or earlier, job interview expenses paid by a prospective employer, interest on qualified savings bonds you redeem to pay for qualified higher education expenses in the same year, the sale of personal property you sell at a loss, but the loss is not deductible, scholarships and fellowships used to pay for tuition fees and books, veterans benefits paid by the Department of Veterans Affairs, utility rebates that are reduce the amount of the purchase price of electricity furnished to you or give you a non-refundable credit against the purchase price of electricity, and finally, money that you borrow and are required to pay. None of those items are taxable income, and most of them don't get reported anywhere on your tax return. But what is taxable? Well, Alaska permanent dividends are taxable. Activity from a not-for-profit activity. So basically a not-for-profit activity such as a hobby that produces income for you is taxable. Alimony is taxable. Court awards and damages for lost wages or profits, punitive damages, settlement of pension rights, patent or copyright infringement, breach of contract, back pay or damages relating to emotional distress from civil rights violations. Credit card insurance payments are taxable. Jury pay, all $10 a day, is taxable. Estate and trust income distributed or required to be distributed to you, these amounts generally appear on a Form 1041-K1. Bribes are taxable. Rents received for the use of personal property, net business income after expenses, fees for services you perform as a corporate director, executor, or administrator of an estate, as a notary public, or as an election precinct official are all taxable. Foster care payments you receive from an agency if you care for more than 5 individuals age 19 or older. Difficulty of care payments you receive for the care of more than 10 qualified foster individuals under age 19 or more than 5 qualified individuals age 19 or older. Payments received for maintaining space in your home for the care of foster individuals. Gambling winnings, lotteries and raffles, illegal income, prizes, awards, and free tours are taxable to you. Sale of personal property you sell at a profit is reportable on Schedule D. Scholarships used to pay for room and board are taxable. Strike and lockout benefits are taxable. And canceled debt other than by gift or bequest is taxable. So that concludes the lecture portion of Session 3. The next activity for the day is to break and do your classwork assignment. The classwork assignment is 2 parts. 2 simple short tax returns. I'm going to read both of them to you. Then what I'd like you to do is just push pause, prepare these assignments in your own time, and then resume playback for a review of the classwork answer keys. So classwork number 1 involves preparation of Form 1040 and Form 4137. John Walker is married to Donna Walker, who is blind. We provide you with their years of birth, and it's your job to establish what their ages are. They live in Portland, Oregon. John is a bartender. He regularly receives cash tips and does not report them to his employer. John does not keep a tip log, and he won $1,300 in a slot machine in Las Vegas. He can also prove that he had $900 of gambling at losses. Based on their Schedule M, the Walkers will receive an $800 making work pay credit. His W-2 is attached. Go ahead and prepare his tax return. So just reviewing the W-2 with you, we can see that he has $25,000 of wage. He has allocated tips showing in box 8. And he has a 1099 or a W-2G rather showing his gambling winnings, $1,300. So go ahead and prepare the Walker's return. Classwork assignment 2 involves preparing a tax return for David Lerner, who is single. He also lives in Portland, Oregon. He is a senior at high school. He has a senior at high school. He is, so David Lerner is single. Redo. On to classwork assignment number 2. We have a problem that is much simpler, only preparing Form 1040. James Lerner is single and lives with his son, James Lerner. James is a senior at high school. David's ex-wife pays him $400 a month spousal support and $400 a month of child support. David pays more than half the cost of maintaining his household. He was unemployed for the year and received a 1099-G. He works as an electrician. His W-2 is attached. He is going to receive a $400 making work pay credit. Use the information reported on the 1099-G and on his W-2 to prepare his tax return. So at this point, please push pause. Allow yourself enough time to prepare both of these tax returns. We recommend strongly that you prepare these tax returns by hand, but if you have confusion... Okay, welcome back from break. The first thing I want to do for you is just point out that I'm giving you the final password of today's class, and it is also the password to unlock the the Session 3 classwork answer key. So let me just scroll across so you can read this. So the password to open the Session 3 classwork answer key is Arabian, as in Arabian horse. Please write that password down and use it to unlock the key and also to complete the password test today. John Walker's W-2 and 1099, W-2G are shown there. And in front of you now, I'm just pulling up the Classwork answer key. What I need to point out to you is that John Walker was age 64 on the last day of the year. We got that from his year of birth and subtracting that from 2010. He is not qualifying for the additional standard deduction because of age. However, Donna does qualify for an additional standard deduction because she is blind. John received $5,000 of allocated tips, but he did not keep a tip record, so he is going to have to complete Form 4137 and pay Social Security Medicare tax on that allocated tip, as well as include the allocated tip on line 7 of his tax return as income. He's going to have to report $1,300 of gambling winnings. He has losses, but he doesn't get to deduct them because he is not itemizing his deductions. So let's take a look at his finished 1040 return, which I now have up in front of us. And you will see that the wages reported on the W-2 of $25,000 are going to be added to the $5,000 of allocated tips. So the sum of those two numbers is where we get $30,000 from on his finished return. The gambling winnings are entered on line 21, and that gives him adjusted gross income of $31,300. We go over to page 2, and we're claiming a higher standard deduction than the normal standard deduction for a married filing joint couple. Here on line 40, we're entering $12,500 instead of $11,400. We also enter exemption deductions of 2 times $3,650. That gives us $7,300. And we're going to subtract $12,500 plus $7,300 from $31,300. And when we do that, we get $11,500. Now it's time to go to Pub 17 and look up the tax in the tax tables. With this low a taxable income, I know that they're going to be in the 10% tax bracket, so I could really take $11,500 and multiply that by 10%, and I would get $1,150, wouldn't I? But the tax table, of course, pulls that up by $3, and ultimately we enter $1,153 on the line. Now going over to line 57, we do have to attach Form 4137 and figure the Social Security Medicare tax on those tips. So I'm just going to go over to Form 4137. Here we have $7,000 of income that is going to be subject to tip tax. And so we're going to, actually that's the total, pardon me, let me word this differently. $7,000 is the amount of tips that he reported to his employer, but he actually received $12,000 of tips. So the difference between those two numbers is 5, and $5,000 is the amount on which he will calculate his tip tax, which is 6.2% plus 0.145 multiplied by $5,000. We take those two numbers of $310 and $73, and we get $383. That $383 carries back to the Form 1040 and is entered, come here, on line 57. We have line 61, $2,000 of withholding. That was shown on his W-2 right here in box 2. And then we add to that $383, pardon me, we add to that the $800 rather, and we have a total of $2,800 of credit and withholding that he can claim. He subtracts $1,536 from $2,800, leaving a refund of $1,264. So that concludes the review of the Classwork answer key. At this point now, we're going to move on to, or go back to the manual. And I'm just going to give you a review of what your homework assignment for today is. The homework assignment involves preparation of more tax returns, and it starts on your manual on page 32. The character's name is Jackie Rhodes, also living in Portland, and her husband Jonathan died during 2009. Jackie has not remarried. Jackie has 2 children living with her whom she supports. Her daughter Kathy Lee Rhodes and her nephew Sammy Smith both lived with her all year. Jackie is a teacher. She also is a server on the weekends at Alice's Bar and Grill. She did not report any tips to her employer and does not keep a tip record. Okay, she has a Making Work pay credit she can claim of $400. Go ahead and prepare her return. So we'll review that answer key at the beginning of session 4. And that is it for your homework assignment for the day. So I will see you At the beginning of next class, we will begin Session 4 with a review of the Session 2 quiz. We'll then move on to a review of the Session 3 homework assignment. Then you will take the Session 3 quiz, and then after that, we will move on to the Session 4 lecture. Thank you for participating in today's class. Again, if after reviewing all of the answer keys associated with today's material, you still have questions,